The basics of retirement income planning. You've spent your life working hard to earn all the money you need to pay your living expenses, and hopefully to put away enough money for your retirement years. In financial circles, we refer to this as accumulation. Then, when you've reached that point in your life when you're ready to stop working and enjoy the leisure time that you so justly earned, you will need a distribution or retirement income plan to fund your retirement in much the same way that you needed a retirement savings plan to save for retirement. Now, a retirement income plan is a blueprint of how you will organize and leverage all of your retirement resources into a predictable, reliable, and permanent retirement cash flow. Predictable means knowing where your income is going to come from. For example, what sources of retirement cash will you have to leverage, and how should you protect and sequence each of them? And here's a list. So for example, to replace your paycheck, you'll probably take your Social Security, and if you have a pension, you'll access that, together with your tax-deferred accounts. Or you may decide to take distributions from your tax-deferred accounts and then wait to take your Social Security together with tax-free distributions from a Roth IRA. Now, there are very important tax implications to how you sequence the distributions of your various types of income. Now, if you don't happen to have, say, a Roth IRA for tax-free income distributions, you might want to consider converting some of your tax-deferred accounts to Roth IRAs or perhaps life insurance to create a tax-free income or a tax-free inheritance. Now, if you have stocks or mutual funds, you may want to consider how much you could lose if the stock market should drop during your retirement. And how will your cash flow be impacted by inflation, changes to the tax codes, or long-term care expenses? These are all risks that can negatively impact your retirement cash flow. Reliable refers to income that is sufficient to cover all your retirement cash flow needs. This is where we discuss the distinction between essential and discretionary expenses. Essential expenses include housing, groceries and personal care, transportation, and health care. Every morning you wake up in retirement, you will be spending money on all of these items. So it's critical that you have guaranteed streams of cash flow to cover your essential expenses. Then there's discretionary expenses, which include travel, maybe a second home, maybe even a boat. In other words, all your bucket list items, those things that you really want to do during your retirement years. Now, in this area, we will spend a lot of time on budgeting and cash flow management. Permanent represents consistency of income over a long period of time. In other words, will your retirement income last as long as you will? Now, according to data compiled by the Social Security Administration, a man reaching age 65 today has a life expectancy of more than 84 years. A woman age 65 today has a life expectancy of more than 86 years. It's also noteworthy that 1 of every 4 65-year-olds today will live past age 90, and 1 out of every 10 will live past age 95. And married people will live even longer. What all this means is that people retiring today are likely to have retirement horizons of at least 20 to 30 plus years, which means that they need guaranteed streams of income, which include Social Security, pensions, income from annuities, government bonds, interest from bank accounts, and withdrawals from life insurance. Non-guaranteed streams of income include distributions from stocks and mutual funds and also dividend income, non-government bonds, real estate, and finally, wages that people earn during their retirement. When considering your retirement income plan, you should take into account these important aspects. Sequencing. You will likely be drawing income from more than one source during your retirement. How much and when you receive this income is very important. For example, when should you take your Social Security? As early as age 62? Should you wait until age 66, which is full retirement age for many people? Or wait until age 70 to maximize how much you will receive? Also, distributions from tax-deferred accounts is an important consideration, especially if you have the option to access tax-free income from, say, Roth IRAs or life insurance. Again, how you sequence your income sources can play a big part in how long your funds will last and how much you will ultimately pay in taxes. Healthcare will be a very big retirement expense for many retirees, with numerous options to consider. Taxes and tax planning should play a significant role in your retirement income planning. Inflation will certainly erode your purchasing power during your retirement years. Even if inflation stays as low as 2 or 3%, over 20 years, this will reduce your purchasing power by as much as half. Your retirement income plan must consider how you will keep up with inflation, or you risk a reduced standard of living over your retirement years. And longevity. People are living much longer than ever before. Your retirement income plan must have streams of income that are guaranteed to last as long as you do. It's also important that your retirement income plan draws a distinction between essential and discretionary expenses and guaranteed versus non-guaranteed income streams. Now, this has been only a short presentation designed to present the basics of retirement income planning. So for more information on retirement income planning, contact me, Michael Graff, of Pro Income. You can call me at 781-248-7344 or email me at mgraff@proincomeplan.com. Thanks for watching, and be sure to check with your tax and legal advisors as you consider this information.